Okay, hi everybody. My name is Molly MacKenzie, and this is my financial analysis for the fall 2017 class of Finance 653. Okay, so the three industries that I picked were the entertainment industry, the health, which is weight loss and supplement included industry, and the fitness industry, which includes equipment and tools. Okay, the five companies that I picked in the entertainment industry would be Disney, Discovery Communications, Fox, Times Warner, and CBS. From the health industry, I picked Medifast, Nutrisystem, Weight Watchers, GNC, and Vitamin Shop. And then finally, from the fitness industry, I picked Brunswick Corporation, Gaia Corporation, Nautilus, Planet Fitness, and Town Sport International Holdings. To do this financial analysis, I will start with looking at each industry individually, looking at the history or what's going on in the industry, and then see how it affects their financial statements by looking at all of their different financial ratios. So first I'm going to start with the entertainment industry, which includes Disney, 21st Century Fox, Discovery, Times Warner, and CBS. Looking at what's going on in the entertainment industry, there has been a huge movement in the way online streaming that differs from the traditional forms of entertainment. So companies like Hulu and Netflix have really impacted the old industry of entertainment. Disney and Discovery are just two of the companies that are focusing more on digital distribution. And this is just to combat the shift in the market. It's basically become like a streaming war. And these entertainment industries are realizing that more and more things are going online and they need to change up what they're doing to keep up with the times. Print media is also declining. And even though there has been a shift in more online technology and entertainment, these entertainment industries are investing a lot of money into new experiences in the theater, like 3D entertainment. And the issue with this is that there just hasn't been a big enough return. So now that we know a little bit of what's going on in the industry, we're going to look first at the entertainment's short-term solvency ratios. We're going to look at each company individually and then compare them over the 5 years. So DIS, or DIS, which is Disney, their short-term solvency, they have consistent liquidity ratios. Their current ratio is above their quick and cash, and there really doesn't seem to be anything wrong with their short-term solvency. Disco's short-term solvency has seen a dramatic drop in all three of their liquidity ratios in 2014 and 15. But they've evened out just at a lower number, so it seems like they're getting back on their feet after that major drop in 2014. Looking at Fox's short-term solvency, they had a spike in their liquidity ratios in 2015 and now are evening out again. And looking at Times Warner, or Twix, their short-term solvency is consistent across the board, except for the fact that their cash ratio is substantially lower than their current and quick. So it looks like they have a lot of inventory and receivables, and then once you take that out, they don't have a lot of cash. Lastly, looking at CBS's short-term solvency, they have an increase in all of their liquidity ratios, and the only downfall is how much lower their cash ratio is. Again, just like how we saw in the other companies. Now comparing the industry's current quick and cash ratio across all five companies, we see that Fox has the best current ratio out of all five of them, and Times Warner has the most consistent. Disney, Times Warner, and CBS have consistent cash ratios, but Discovery is experiencing a drop, and Fox is also in a decline. And again, Disney, Times Warner, and CBS have consistent quick ratios, while, again, Discovery is experiencing a major decline. Now looking at their long-term solvency ratios, we're going to first look at the equity multiplier of all five companies. CBS is seeing an increasing slope in their equity multiplier, but considering all of the other four companies, they are pretty consistent across the board. Looking at the times interest earned ratio, Disney has a dramatically higher ratio than all of the five companies, a lot higher. This usually means that the company is not using excess income for inventory for reinvestment, but it looks like in 2015 they are dipping back down. Looking at the total asset turnover ratios, every single company has a consistent total asset turnover ratio, whereas Disney is the highest out of all of them. And Times Warner and Discovery are the lowest. Looking at the profitability ratios, which would include the profit margin, ROA, and ROE, CPS has a spike in all three of these ratios in 2014, and Discovery is experiencing a drop in all three. Disney, Times Warner, and CBS have consistently increasing profitability ratios, but Disney is the most steady increasing ratio, which is really good. Their ROE is just seeing a steady incline from 2012 to 2016. Looking at their market value, Discovery is seeing a decline in their profit to earnings ratio. They have the lowest enterprise value ratio and a major decline in their enterprise value over EBITDA ratio. Times Warner has the most consistent market value ratios, and Disney has the highest enterprise value, which is super exciting because you want to have, it's not bad if you don't have a high enterprise value, but you want to because it just shows a positive future, and it just shows you that you're using your, looking at your opportunity costs and really making smarter decisions. Looking at their free cash flows, Disney is seeing a increase from 2012 to today. Discovery is very consistent. It hasn't really increased or decreased or anything like that. Fox is seeing it increased in 2015, but then went back down. And CBS is really lagging behind all of the companies. Discovery and CBS are very similar in their free cash flows. Looking at their cash flows to equity, Disney is seeing a major increase in their cash flows to equity. So either that their retained earnings are getting higher, they're paying off their dividends, one or the other. They're doing really well. And Discovery and CBS are, again, the lowest out of these companies. Looking at their WACC ratios, if you're looking at Disney, theirs are the most consistent. Theirs are pretty consistent. Their ROIC is increasing, which is good. If you're looking at CBS has a huge dip in their EVA spread, which is not a good sign. They also have in their EVA, it's also dipping. If you're just looking at these, Disney is the most consistent across the board. Considering all of the companies that we looked at, Discovery is seemingly experiencing some difficulties, which we saw through the ratios, and would not be the best choice. CBS has consistent financial ratios, but it doesn't look like there's any major growth. They were also pretty low, even though there were no major spikes or declines or anything like that. Disney and Fox seem to have a lot of new growth, along with their increasing financial ratios, which is very positive. From the data presented, Disney is the most attractive company, in my opinion. It is stable and diversified, along with having decent liquidity ratios. Its economic value is above its average cost of capital, which also shows it to be the best choice. So from the entertainment industry, I choose Disney as the best company. But now we're going to look at the health industry, which includes the companies of Medifast, GNC, Nutrisystem, Weight Watchers, and Vitamin Shoppe. Looking at what's going on in the industry, first, we see that there is a decline of 12% in the total amount of population on diets, which has generally affected this industry. It is a huge industry. It's a $64 billion industry since 2014, but more and more people are leaning away from the calorie counting and the frozen meals because they want to look at a more healthy lifestyle and something that can keep them at either losing weight or at a sustainable weight for a longer period of time. Basically, the word diet has been seen as a bad word, and more people are moving away from saying that they're on a diet. A greater acceptance of body types has also affected this industry because before, you wanted someone to look a certain way and people who didn't, they wanted to look like that. But now more and more people are okay with the way they look and aren't really necessarily wanting to go on a diet. Even though this weight loss industry is growing because they want to see a more holistic lifestyle, Americans are still gaining weight. Obesity is higher, which has helped the health industry, but it's just shifted its focus. Americans are becoming smarter, realizing that these programs are only a quick fix, but do not really keep the weight off. And even with these frozen meals that all of these companies provide, shoppers are realizing that even though it says it's healthy and low in sodium and whatnot, they realize that they're still hungry after they eat them, and they're really not as healthy as they claim to be. So, also, a decline in skinny pills has been seen over the years. So now that we know what's going on in this health industry, we're going to take a look at the short-term solvency of these companies. We're going to start with Medifast. Over the past 5 years, they have seen a steady increase in their short-term solvency, which is good. They're utilizing their assets very well and converting them into cash relatively well as well. Now we're going to look at Nutrisystem's short-term solvency ratios. Basically, their current ratio is the highest out of all the liquidity ratios. Its quick cash ratio is relatively the same, but significantly lower than their current ratio. Now looking at Weight Watchers short-term solvency, their current ratio is the highest out of all three. All three ratios decreased in 2015, and their current ratio is increasing, but their quick and cash are still struggling. Looking at GNC short-term solvency, all three of their ratios are declining, and their current ratio is substantially higher than their quick and cash. So it seems like they have a lot of inventory, and once they take those out of the equations, they're quite low. Lastly, considering Vitamin Shopp's short-term solvency, their current ratio is again much higher than their quick and cash, so they also have a lot of inventory that they can't move. This is causing their quick and cash to be a lot lower than their current ratio. Now comparing the current quick and cash ratios over all five companies over the 5 years, Medifast is the only one that is increasing. It's looking the most promising in the health industry so far. You can see that Medifast is the highest out of all of these ratios, and just seeing a more positive impact. Now considering their long-term solvencies, comparing all five companies, GNC has an exponential increase in their equity multiplier. So basically, it seems that they have borrowed more money from their shareholders and borrowed more money from debt, which isn't impressive because anyone can borrow debt. So they're getting their money from the wrong places, trying to sustain their company. Looking at the times interest earned ratio, Vitamin Shoppe has taken a nosedive in their times interest earned ratio. They're struggling to pay back what they owe. They have also a steady decline in their stock. Now considering the health total asset turnover ratios, comparing all five companies, Nutrisystem has the highest, meaning they are efficient at making their money, and Medifast has had a decrease, whereas Vitamin Shoppe has stayed the same. Looking at the profitability ratios of this industry, all three GNC has taken a huge nosedive in their profit margins, their ROE, and their ROA, so it doesn't look like this would be a good choice. Nutrisystem is seeing a steady increase over the years, while Medifast is pretty consistent if you're looking especially at their ROE. Their ROE has been consistent since 2012 to today. GNC has a negative ROE, which indicates a negative net income in 2016. Now looking at their market value, you can see that Nutrisystem is very sporadic across with their PE ratio, with their market to book. Medifast is doing the best with all these ratios. And GNC is also seeing a decline in every single ratio. just like they've seen a decline in their other ratios. Now looking at their free cash flows, Medifast is very consistent. GNC has had a major incline in their free cash flows up to 2015, and then it went down 2016. Looking at their cash flows to equity, Nutrisystem is in the negative. Weight Watchers has a huge number in the beginning, and now they've slowly gone into the negative. And then finally looking at the WAC sheet for all of these companies, Medifast, even though these are all over the board, Medifast looks like the most consistent. GNC is taking a nosedive in their ROIC, their EVA, and their EVA spread. And Weight Watchers is consistent, but in 2015 in all of these ratios, they went down, and now they're trying to gain speed. From the graphs, it's safe to say that GNC is definitely not the best. Vitamin Shoppe is also experiencing some difficulties, and that's not shocking because both GNC and Vitamin Shoppe are very similar in their business approach. Medifast has the best short-term solvency ratios because over the 5 years, they had seen a steady increase. They also have a steady equity multiplier, unlike GNC, who had to borrow a substantial amount in 2016. Lastly, Medifast really does seem like it has the most consistent ratios. Looking at their ROE, it's very consistent. It seems like Medifast is the best company out of the health industry, and it just makes sense because the products they offer are for more obese people. So their target market is one that is increasing in the United States. Now, lastly, looking at the fitness industry, this would include the Brunswick Corporation, Gaia, Planet Fitness, Nautilus, and Townsport International. We're going to look at the history or what's going on in this industry first, and then look at the financial statements. So basically, gym and exercise equipment have seen a decline over the past 5 years, and this is primarily because this equipment is so hard to transport. It is extremely heavy and cumbersome, and it's expensive. And so they're just seeing how hard it is to get it from point A to point B. There's a major threat of globalization and a big threat in a rise of imported goods. Cardiovascular equipment is the primary equipment that's driving this industry, and that is also because of the incline in obesity in America. There's expected growth in India and China. Another reason why this equipment is seen, or this industry has seen decline, is that because the equipment is so large, it's also very expensive, and people are more aware or more fond of the fact that they can work out at home and not have to go to a gym. So it's trending towards online usage. Planet Fitness really focuses on using the cardiovascular equipment because their market is very unique. It's not like a normal gym, and so they're doing pretty well. Now we're going to look at the short-term solvency again of each company and then compare them over the 5 years. Brunswick has consistent short-term solvency ratios, with their current being the highest. Gaia is seeing a huge spike in 2015. Looking at Nautilus's short-term solvency, they're pretty consistent, and there's no major difference between all three of their ratios, which is good. Planet Fitness, they went public in 2013 and have seen a really consistent short-term solvency. Finally, looking at Club's short-term solvency, they had a spike in 2014, and then it's just dropped since 2014 to today. Looking at comparing the current quick and cash ratios over the 5 years for these 5 companies, Gaia is seen in the most improvement. And I think one of the factors that's contributing to this is the popularity of online workout videos. Moving on to Fitness's long-term solvency, their equity multipliers. If you're looking at the equity multiplier, BC has had a major decline in theirs. The other companies are pretty consistent throughout the years, and Planet Fitness has seen an increase. Now, the Fitness's timed interest earned ratio is a little off because a lot of these companies didn't provide their tie ratios. Nautilus saw a major increase in 2015 and then has seen a major decline since then. Looking at the total asset turnovers, Nautilus, Gaia, and Planet Fitness all have declining TAT ratios, whereas BC and Club have increasing TAT ratios. Gaia's profitability ratios are increasing in 2015. Their profit margin is soaring through the roof, as well as their ROA and ROE. Planet Fitness is pretty consistent across the board. They've actually seen an increase in their ROE, which is positive. Looking at the market value ratios in all 5 of these companies, you can see that Club is all over the board. They had a major decline in 2014 in their PE ratio, and again in 2016. BC is above everyone in their enterprise value, but if you're looking at Gaia, they're pretty consistent, except for their enterprise value over EBITDA ratio. Looking at the free cash flows, you can see that Gaia was negative in 2013 and 14, but it looks like they are trying to get back on track. BC is negative in 2012 and 13 for their cash flows to equity, and Planet Fitness has a large cash flows to equity in 2014. Looking at their WACC sheets, you can see that Gaia is, again, the most consistent out of all of these. Planet Fitness has seen a decline in their EVA spread and their EVA, but an incline in their ROIC. Now, considering all 5 of these fitness companies, you can see that none of them are outstanding. Gaia stood out as the best to me because you can see there's an increase in their liquidity ratios, but also with how they're positioned in the market with offering online fitness videos and the type of equipment that they offer, it seems like they have the best chance of being okay with the changes in this industry. Comparing the top 2 companies that I chose out of this financial analysis, the top 2 that I chose were Disney and Medifast. Disney has the most stable ratios in the entertainment industry. They have a lot of diversification, decent liquidity, and their economic value added is above its average cost of capital, which is positive. Medifast was the best in the health industry because they have steady liquidity ratios along with a strong equity multiplier ratio. Their ROE is also steady and seems to adjust to how the company is faring, which is positive. Now, comparing these 2, the best that I picked out of this entire financial analysis was Medifast. Looking at all the different factors that affect the financial ratios of these companies, Medifast has the most promising future along with strong ratios, which is good. With the increase in obesity in the United States, it looks like Medifast has the best chance to come out on top. What the product that they offer can be specifically marketed to obese individuals, which is positive for this company. They have steady ratios that seem to experience very little shock. And because Medifast can also serve the medical industry, they're able to market to many different segments, which will also help their cause. Thank you so much.